Hello students, you are the future chartered accountants of India. I am C Abhijith Acharya, welcoming you all for Abhi CA Classes. We have started the concept of depreciation in the previous part of the PGBP chapter, right? Today we are continuing with that, and without wasting further time, let's get started today's classes. The method of depreciation. There are two methods of depreciations. The first one is WDV method. The second one is SLM method, that is straight line method. SSE, if SSE is having a business of generation or distribution of electricity power, then that business holder is having an option to claim the depreciation under SLM method. If the same as if the SSE, if any other SSE is, there is only one option, that is to follow WDV method. If in his books of accounts he can choose any of the method of depreciation, but for the sake of depreciation as per the Income Tax Act, there should be only two category. For other SSEs, it is always the WDV, irrespective of the fact whether they have followed any other method of depreciation. But for generation of electricity power, there is having one option, that is you can choose the depreciation under SLM method in order to claim the depreciations. Okay, then there is a format for computing the depreciations. First, you have to take the opening WDV of the block of the asset. Block of asset means the building, furniture, plant and machinery, and intangible asset. The WDV of the whole block of the asset should be taken. Add the actual cost of asset acquired during the previous year 23-24, that will be classified into three categories. Number one, that asset is put to use on or of put to use for 180 days or more. 180 days or more means if it is, for example, if that asset is put to use before for example 3rd October 2023, then that can be taken first. Second, then put to use for less than 180 days, that has been for half of the year, then that should be taken. Why it has that classification is needed in order to compute the depreciation. That's why. Then the last category is acquired but not put to use. For example, we have discussed some of the assets that has not been put to use, but depreciation should be claimed only for those assets for which the asset should be put to use. If that asset is not put to use, then the depreciation cannot be claimed, but it must be added to the block of assets, right? So that is also forms a part of that. If you add the actual cost that has been purchased in the previous year 23-24, then you will arrive at some one figure that should be deducted from the money payable or sale price. If in the question that FMV, that is fair market value, is given, then it should be ignored. Then only selling price, actual sale price, should be taken. Why it is important? If the sum of the assets in the block is being sold out, then that selling price should be deducted from the this so original WDV plus actual cost purchased during the year. Okay, then the WDV of assets transferred in a slump sale. What do you mean by slump sale? We'll discuss in the capital gain chapter. The ratio should be taken deducted. Then you will arrive at net WDV for the computation of W depreciation. I have star mark over there, and we'll discuss the concept in here under. First, after that, we have to deduct the depreciation as per Income Tax Act, then to arrive at the final closing WDV of the block of the assets, okay, which will appear in the balance sheet of the taxation business balance sheet, okay. First, opening WDV plus the additions made during the year, which will be categorized as put to use 180 days or more, 180 days less, or not to put to use, should be deducted from selling price minus slump sale to arrive at the net WDV on which the depreciation is going to compute. Next, minus that depreciation actually allowable as per the company also the taxation to arrive at the final closing WDV of the block of the assets. Okay, then I have mark star mark over there, and the explanation for which is here under. The WDV of the block of depreciation, which will be classified into three that I have discussed already. First one, assets acquired but not put to use, for which the depreciation will be nil, as we have already discussed in the basic, the introduction part. Net depreciation will be nil. Next, the asset acquired for less than 180 days. For those categories of assets, the depreciation will be the actual rate. For example, the plant and machinery has been purchased in the month of November, and accordingly it is put to use for less than 180 days in the previous year 2024. Accordingly, the depreciation rate would be 15% as per the rate prescribed thereunder. Into 50%, only half of the depreciation rate would be charged as a depreciation for that asset, respective asset. Okay, and in this case, the plant and machinery cost into 15% into 50%. Half that 50% means half for those assets which have been put to use for more than 180 days or more. For example, when the same machinery is put to use in the month of July 2023, and obviously it has been put to use for more than 180 days, so accordingly the rate, for example, 15% into 100%, for example, in other words, it is fully depreciation will be charged, that is 15% of the cost of the asset will be charged as a depreciation. For put to use less than 180 days, then 7.5, that is 15% का 50% होता है, 7.5 percentage of the cost of the asset would be charged as a depreciation. If the same asset is put to use for more than 180 days, for more than or equal to 180 days, for that those categories of assets, the depreciation would be 100% of the actual rate prescribed thereunder. Okay, then money payable. But remember that 50% is there, no, 50% of the rate that is will be prevailing only in the year of acquisition. For the remaining subsequent years, there is no concept of 50% or 100%. Entire 100% can be charged as depreciation. Okay, only during the purchase year, only during the year of acquisition, that provision of 50%, 180 days should be received. Okay, money payable includes sale price, or the money payable should be deducted right in the above. That money payable in the sense the sale price or the capital gain, or sorry, selling price or insurance compensation in respect of those assets which has been discarded or destroyed in the previous year. For example, if my plant and machinery is destroyed due to any unexpected event, then for that the insurance gives one of the claim for that. For that also will be reduced from the WDV of that, because we are not in a position to identify that prevailing value. So accordingly, the insurance claimed amount should also be deducted. Likewise, the selling price of the from the block of assets. Okay, then the section 50, very important. Section 50 is sale of asset or the capital gain in the case of depreciable asset, that is block of assets. In terms of some of the assets which are depreciable in nature, the capital gain might occur, in which there are two categories, there are two cases which we'll discuss with the example, so that in examinations you will be in a position to solve those questions. First case, where a block of assets ceases to exist. That means in a block, for example, in a plant and machinery block, the entire assets are nil, does not exist. There is no assets under the block of plant and machinery. In that case, what would be the consequences of capital gain or any other concept? For example, we'll take in order to better understand this concept, we have taken one examples. Opening WDV of the block of, for example, plant and machinery is a costing of 5 lakh, which consists that block consists 5 machineries in the opening, that is 1st April 2023. In addition, we have made purchases some of the assets, some of the plant and machinery of two plant and machineries having the cost of 3 lakh. So entire the 8 lakh rupees have for 7 machineries. 7 machineries costing 8 lakh is lying in the block of the plant and machinery, out of which the entire 7 machineries has been sold in the previous year 23-24 for the rupees of 7 lakh, even though the remaining 1 lakh is there, but there is no asset to count, and accordingly there arises a capital gain concept of capital loss concept. Here the capital loss is there, no asset is there, right? No asset. The capital gain or loss would be selling price is 7 lakh, the opening WDV plus the addition made during the year is 8 lakh, Then comes to there is a loss because selling price is less than the WDVs, and accordingly short-term capital gain, short-term capital loss would arise. There's of 1 lakh rupees. I hope you have understanding this. Entire 7 assets have been sold out, even though the 1 lakh is prevailing, 1 lakh is remaining, but there is no asset to count. So accordingly, short-term capital asset or loss would arise. In this case, the short-term capital loss would arise. But remember one thing: transfer of depreciable assets would always amount to short-term only, not a long-term capital gain, not capital loss. The depreciable asset, because every year the depreciation is claiming, right? So according it as per the income tax authority, income tax rules, it would be form a part of short-term capital asset, and accordingly any gain or loss would also be treated as short-term capital loss, short-term capital gain. Okay, remember. The second cases where it would be where it would lead to the capital gain. Let's assume where some of the assets in the block are transferred. Same example, opening WDB is amounted to 5 lakh, having the 5 machineries. Actual, we have made purchase 2 plant and machinery having the cost of 3 lakh. Accordingly, we do have 7 machineries having the WDB of or opening cost of 8 lakh in our books of accounts. Okay, but the 5 machines have been sold out in the 23-24 financial year, previous year, for amounting to rupees 9 lakh. Even though the assets value of 7 machinery is 8 lakh, for 5 machineries have been sold out for 9 lakh, there is no value there in the block of asset. The block of asset would not be the negative, it should be nil or positive. In this case, even though the 2 machineries are remaining in the block of assets, but its value is negative, and accordingly the capital gain, capital loss would arise. Always remember short-term capital asset. This is depreciable assets are always short-term capital asset. It can be asked in your MCQ. The same concept: LTCG, STCG, LTCL. That means long-term capital gain, long-term capital loss, or short-term capital gain, short-term capital loss. You have to exclude the first 2 options. We have to see the third and fourth options in order to satisfy, because always the depreciable assets form the short-term capital asset. That's it. In this case, even though the 2 assets are remaining, but its value is negative in the nature, so it should be ignored. So this value is nil, absolutely nil, and accordingly the capital gain concept would arise. That cannot be negative. That's why we have discussed the capital gain would be the selling price. That is 9 lakh. The minus that cost of that is 8 lakh. That is 1 lakh would be the short-term capital gain in this case. Okay. In this case, even though the assets and the block exist, that is 2 assets are remaining in the block, but its value is negative, so it leads to capital gain always. Always capital gain. It would not be the capital loss. Okay. Then we will discuss the second concept, that is additional depreciation. That is section 32 subsection 1 subclause 2a. It is available only if the SSE is engaged in the business of manufacturing of an article, any article or generation, transmission or distribution of power, that is electrical power, electricity power. Remember, if any business is having, for example, trading activity, then this section will not be applicable. Only if that SSE is having a business of manufacturing of any article or distribution of power, then only that additional depreciation would be available. Remember, the rate would be 20% on only on plant and machinery, but that plant and machinery excludes the following category. First one, the second hand plant and machinery. That plant and machinery should be always the original, always be first in hand. That is always be original plant and machinery. If you purchase any of the second hand plant and machinery, for that, so the depreciation can be given, additional depreciation will not be given, even though you are under the manufacturing activity, you are in the power generating sector. Okay, it should be always a new. Second, any plant and machinery installed in office premises or a residential accommodation, that's for those assets also the additional depreciation would be nil. For example, office premises, you install one of the AC, that is air conditioner, for which the depreciation would be 15%, but the additional depreciation would be nil because it has been installed in office premises. Then where do we should install? It should be installed in a manufacturing unit. that, for example, some of the units, there are the machineries, large machineries, for in order to help in order to manufacture some of the assets. For that plant and machinery, that additional depreciation would be given. For the machineries that has been installed in office premises or your residential houses, then that additional depreciation would be nil. Okay. Then for ships, aircraft, or transport vehicles, the additional depreciation would be nil, but normal depreciation can be claimed. For the plant and machinery on which 100% deduction is already allowed, already available. For example, under section 35A or 35D research sector, that the brief that the in detail we'll discuss in the upcoming slides. As of now, it is okay. For plant and machinery on which 100% deduction is already availed, for which no additional depreciation is, because its value is already nil. I'll tell in brief what you mean by 3580 says it is a specified business. For some specified business, as per the Income Tax Act, that is, there are 14 or 15 specified business are there. That specific business acquires any of the plant and machinery for which 3580 section will be applicable. That means the entire cost of purchase can be claimed as a revenue in nature, and accordingly the net WDV would be zero, which is nil in its balance sheet. Entire depreciation can be claimed as that is entire allocation, that is entire amount can be allowed as a deduction under revenue, under profit and loss account. Accordingly, its WDV is nil, so additional depreciation obviously logically not possible because its WDV is nil, right? Accordingly, this concept is given. There are some notes. Additional depreciation is allowed only in the first year of put to use of plant and machinery. It is allowed only in the first year of purchase of that plant and machinery. That's it. For example, if I have purchased one of the plant and machinery during the 23-24, that additional depreciation is availed only for the first year, that is 23-24. Okay. In the subsequent year, there is no concept of additional depreciation. There is only concept of actual depreciation, that is 32, section 32. But second point is very crucial. If plant and machinery is put to use for less than 180 days, then 50% of 20%, that is 10%, is charged as an additional depreciation in 23-24. The remaining 10%, that is 20%, remaining 50% is allowed in the subsequent immediate previous year, that is 24-25. I am having the manufacturing unit. I purchased one of the plant and machinery in the month of January 2024, for which the normal depreciation is obviously claimed, but the additional depreciation will also be granted, but 20% can nahi, only 10% will be allowed. Because why? Because only 180 days or less than, for it has been put to use for less than 180 days, right? And accordingly, the 50% of 20%, that is 10%, can be claimed as a deduction, additional depreciation. In addition to the normal depreciation, the remaining 10% is there. No, that can be claimed in the next upcoming years. Okay, this is an extra point. Otherwise, if you are put to use for more than 180 days, 180 days or more than 180 days, then the entire 20% can be claimed as deductions as an additional depreciation in the first year only. Only in this exceptional case where that asset is put to use for less than 180 days, then only that 10% balance can be claimed in upcoming year, only to the extent of 10%, balance 50%. Okay. Next up, business of printing or publishing also amounts to manufacturing, and accordingly the additional depreciation will be granted to that publishing or printing business holder also. It is also form a part of your manufacturing, and accordingly that business holder would be given that additional depreciation. Additional depreciation is allowed only if the SSE follows WDV method. It is not allowed to power units if they follow SLM method. I have discussed the power for generating units. There is an option to claim depreciation under SLM method. If that power generating units claim follow the SLM method, then additional depreciation would be not be provided to those categories. If they follow WDV method, then only this additional depreciation concept would arise. Okay, then additional depreciation is allowed only if the SSE opts for normal tax regime. If he opts for 115 BAC, that is new tax regime, then additional depreciation would be nil. Only normal depreciation can be claimed. If he opts for only under old regime, then only the both depreciation can be given, additional as well as normal. Okay. Then section 43 subsection 1, actual cost. What do you mean by actual cost? The cost of the asset plus the installation cost, for example plant and machinery installation cost, plus transportation of that plant and machinery to the place of installation, plus the test run expenses. We have to make sure that plant and machinery is properly working out, not for that test run would also be incurred. The expenses with regard to test run would also be incurred. That also would be form or part of this cost of asset. Next, the tax and duties, for example ITC, that will also be input tax credit, but remember the ITC would not be claimed. If ITC is waived as per GST Act, then it would not be a form of part of this cost of asset. If ITC is not waived, then only it would be a part of the cost of asset. Next, interest on loan taken for the acquisition of asset. If I have borrowed loan for the acquisitions of loan, for the acquisition of the plant and machinery, then interest up to the date of asset put to use would also be added to the cost of asset. After the asset has been put to use, then that interest would be form of revenue in nature, would be treated as an expenses in the profit and loss account only up to the, I think you have understood in the under section one of the AS A16, I think borrowed cost. In that also the same concept is explained up to the date of, as if I am not wrong, up to the date of asset put to use, then only that asset, that portion of interest should be a form or part of your cost of asset, and that asset should be reduced from amount received on sale of trial run product. If any trial run product is sold, then that should be deducted. Then any subsidy or government only received only with respect to that particular asset, that also to be reduced to arrive at the actual cost of the asset. Original cost, transportation cost, installation cost, test run expenses, taxes if ITC is not aware, interest on loan up to the date of active put to use, up to the date of put to use, it will be reduced from the sale of trial runs product. Also the government grant subsidy received in respect of that particular asset. Okay, to arrive at the final actual cost under section 43(1), where SSE purchase, this is very crucial point, where SSE purchased any of the asset through otherwise than account paging, account paid draft, demand draft, or use of electronic clearing system amounting more than 10,000, then such expenditures would not be a part of your cost of asset. I will explain in brief once again. If I purchase any plant and machinery having the cost of more than 10,000, not through account pay check, account pay DD, or electronic clearing, that is phone pay, Bharat Pay, etc., only through cash, in other words, then that portion would not be form of cost of asset. It should be ignored, and accordingly depreciation would also be not to be provided to that. Okay, this is the very crucial point. This concept has been brought into effect in order to promote the non-cash the transactions in the country. Okay, the next, the explanation to 43 subsection 1, actual cost in special case. There are we will see now the what would be the actual cost. The normally actual cost would be this computation, that is this is a format. In special cases, what would be the actual cost? First, special case, asset previously used for scientific research brought into regular business. I have already discussed under section 35AD, 35D or 35D, actual cost would always be nil, because already the deductions would have been claimed. Accordingly, WD would be nil. Accordingly, depreciation would also be nil. We have discussed already. The second thing, the stock converted into capital asset and used for business or profession. The stock converted into capital asset, then used for business or profession. Then the FMV on the date of conversion would be treated as actual cost of that capital asset which has been brought into effect as an inventory. Okay, simple. Then asset acquired by a gift, will or inheritance. For example, I have been gifted the plant and machinery from Mr. X. Then what would be the cost for me? The cost for me is the actual cost for that person, that is Mr. X, less the deductions already allowed to him. Okay, if he has claimed any the depreciation, then that should be reduced to where the cost for my books of accounts. Okay, then reacquisition of assets sold. For example, I have sold one plant and machinery to Mr. X, then I reacquire that asset to myself again. Then actual cost of that asset in my books of accounts would be the WDV of asset at the time of sale. Whatever the WDV when I sold that asset to him, or the reacquisition cost, what I have purchased, what I have made payment as a concept of reacquisition. Okay, I have, for example, let me clarify once again. I have sold one plant and machinery to Mr. X. At that point of time, what would be the WDV of that plant and machinery in my books of accounts? Or reacquisition cost. Reacquisition means at what price I have again reacquired that asset to my books of accounts. That cost, whichever is less, should be treated as the actual cost in my books of accounts. Okay. Then the fifth category, the asset purchased and leased back to the same person. Okay, I have purchased one plant and machinery from Mr. X, then I leased back the same to him. Then I would be a lessor, he would be the lessee. Okay, then then what would be the cost in my book? Because the depreciation can be claimed only in the hands of, only in the books of lessor, that is me, right? Then what cost I have to take a depreciation? What's the cost? The cost would be the WDV of the previous owner, that is the lessee in this concept. Because Mr. X is obviously lessee after I have made the lease transaction with him, but previously he was the seller, right? I was the purchaser. Accordingly, the WDV of the seller before I made a lease transaction with him, that would be the cost of that asset in my books of accounts. Then only on that only we'll discuss, we'll compute the depreciation. Okay. Then the next special cases, the building was used for the personal purpose, now used for business purpose. If my plant and machinery, for example, I have used one of the furniture till now actually as a personal in nature, but I brought that furniture to my business or profession, then what would be the cost? The original cost minus notional depreciation till date. Notional depreciation means what would be the depreciation if that same asset had been put to use in my business originally, previously. For example, if that asset had not been used for personal purpose, if that asset had been used for business purpose, then what would be the depreciation? The depreciation would be reduced to arrive at the WDV. That would be the cost, simple. Okay. Then capital asset transferred by a holding company to 100% subsidiary company, or vice versa, 100% subsidiary company to holding company. Then the cost or WDV of the transferor company. For example, A is a holding company, B is a subsidiary company. A transferred one plant and machinery to B, that is a subsidiary company. Then what would be the cost of asset in the books of accounts of B company? Would be the cost or WDV in the books of prevailing in the books of the A company. That's it, simple. The same concept, the transferred by amalgamating to amalgamated company. For amalgamating company, the cost of account would be the cost of or WDV of the amalgamating company. Simple. Then transfer by demerged company to resulting company. What will be the cost for resulting company? The cost of the demerged company. Simple. Cost or WDV of the demerged company. Then asset acquired of the borrowed amount. I have discussed already. Borrowed, that is loan. Interest up to the date of asset put to use should be added to the cost of asset. After that, we'll directly debit the same to the our profit and loss account as a revenue and expenditure. Then excise duty or custom duty or GST, input tax credit, to be added only if the ITs is not evaded. If ITC is availed as per GST, as per custom duty, then that portion would be ignored to the form of to the part of the cost of asset. Okay, the government grant or subsidy that should be reduced from the asset if it is related to that asset. If it is related to any other business related, then it should be a form of PGBP income that should be credited to your profit and loss account. If it is related to asset, then it should be reduced from the cost of asset to arrive at the final cost of that asset. Okay, then asset brought into India by NR for use in his business. For example, NR brought any of the business plant and machinery to business in India, then the actual cost of that asset minus the same comes the notional depreciation. Notional depreciation, that depreciation is calculated at the rate in force as if the asset was purchased used in India from the date of its acquisition. The same concept that we have discussed, personal to business in nature is there. Now the same concept, the depreciation, that is notional depreciation, should be reduced to arrive the final cost of that asset. Okay. The next special case, the last special case, actual cost allowed as a deduction under section 35 AD and capital asset is transferred to a non-specified business after 8 years from the date of acquisition. This in brief we will discuss in detail. We will discuss in the upcoming portion. The cost would be nil. I have discussed already because the deduction would already been given to them. Then again the the cost would not be full amount. It should be always nil. Okay. Then explanation 7 of section 43 subsection 6. It says that in case of composite income means we have discussed under rule actually agriculture concept, that is tea, rubber, coffee, we have discussed it. For the purpose of computing WDV of the asset, the total amount of depreciation shall be computed as if the entire composite income of the business is chargeable under PGBP. That means we will not see whether it is a portion of agriculture income or business income. We would see that the entire expense, the entire depreciation is charged only for the business purpose. Then it is a portion. The depreciation so computed shall be deemed to have been actually allowed to the SSE. That has been, that is in short, the depreciation of the asset would be taken in full. There is no concept of bifurcation of the depreciation amount on the basis of 60-40 or 75-25. No, that is apportionment would be seen only for the taxable, that is ultimate profit, not in respect of depreciation. It says that depreciation should be allowed entirely. There should not be a classification, discrimination between business or agriculture. Okay, we'll see in brief through the example. As per section 8, rule 8, it says that income derived from the sale of tea grown and manufacture shall be computed as 40% as a taxable income, that is as a business income, right? I hope you have not forgotten that. If you have forgotten, please go and revise the same. Let's assume the turnover of that business holder of the tea or the tea business is 20 lakh. Depreciation is 1 lakh entirely. Actual other expenses would amount to 4 lakh. Then income would be 15 lakh. Okay, net income would be 15 lakh, of which only the 40% would be treated as business income, that is 6 lakh. The remaining 9 lakh would be the agriculture income. That what this explanation says, that we are not apportioning that 1 lakh into 60-40. We are only apportioning that final amount of income. That's a concept. It also says that 1 lakh is actually allowed as if it has been used for entire business. Okay, simple. So entire 1 lakh being the amount of depreciation would be deemed to have been allowed actually. Okay, simple. Till now we have completed part 2 of this chapter. I hope there might be some more parts in this chapter because it is a vast chapter. So I have planned to simplify as much as I can. So I have planned to simply categorize and simply apportion this chapter into various parts. I think there must be more parts would be there, 5 to 6, if I'm not wrong, if I will not be wrong. But it would be of only 30 to 45 minutes of duration, so that you can revise easily. In my opinion, if I do the entire chapter in one shot, it would be very burden for you, in my opinion. So we will see in the next with this next part in the upcoming in the next class. Till then, please revise. Have a nice day. See you soon. Signing off. CA Abhijith Acharya, Abhi CA Classes. Okay, bye bye.